What's going on, guys? Mike here again, and I'm leaving a business conference down here on South Beach at the Miami Beach Convention Center, and I was asked a question: what the best way is to access the equity in your home, and what the difference is, the primary difference is between a home equity line of credit, which is a HELOC, and a home equity loan. Let's say you have a house that is worth $150,000, but you only owe $100,000 on it. You have $50,000 worth of equity. You could get a separate home equity line of credit for that $50,000, or you could get a home equity loan for $50,000. One of them you use like a credit card. The other is a loan with a set repayment plan, right? You pay it back over the course of 5 years, 10 years, whatever it may be. So one of the questions the gentleman asked is, when you get that home equity line of credit or that home equity loan, are you still paying your first mortgage? And the answer is yes, you're still paying your first mortgage, because it's a second mortgage, right? A home equity line of credit or a home equity loan is known as a second mortgage because it's exactly that. Now, what he may have been confusing it with is a refinance or a cash out loan, right? Where in the scenario I gave earlier, what you would do is do a refinance for the entire $150,000. That creates a new loan instead of having two separate loans, which is your first mortgage, right, for what you owe for when you bought the house, and then the $50,000 of equity. You would just get one loan for $150,000, and then you get $50,000 at closing. So depending on what the purpose is, maybe you're investing in another property. Hopefully it's not to go shopping, right, or to buy a new BMW. But depending on what the purpose is for doing that, presumably you're going to invest that money, and that's why you want to, access it. To clarify, 3 primary ways to access the equity in your home. Number 1 is a HELOC, home equity line of credit. Number 2, home equity loan. And lastly is a refinance of the home altogether, where you pay off the total amount that you owe on the home, right? In the case of the $150,000 house, you would pay off the $100,000 that you owe and also access the $50,000 of equity, creating a completely new loan for $150,000, and then you cash out at closing with $50,000 in your pocket. So I hope this helps, guys. Thanks again. Don't forget to like, share, and subscribe.